Next questioner is Deputy Owen Murphy. Deputy, you have 5 minutes.
Excuse me, and thank you, Mr. David. You're very welcome. Looking at the pre-crisis years, how do the various codes of conduct deal with the situation whereby the valuer was being paid by a borrower, often a large developer, rather than directly by the lender? How did the code of conduct deal with that, or did the code of conduct deal with that?
Well, the code of conduct didn't deal with it because it was the norm at the time. Like valuers were paid by the person who required the valuation, and the bank, if we're talking about bank valuations here now, the bank would tell the valuer to go, or tell the person who was getting the valuation. Some banks are different, but if you look at a situation that you're talking about, a bank would possibly give a valuation form to somebody who was borrowing money and say, there's your valuation form. You take that to a valuer and get it completed and take it back to us. Some of them may have had valuation panels, some of them may not have had valuation panels, so that person would pay the valuer for doing that work.
Okay, and how would the valuer protect themselves then from a potential conflict of interest if it arose?
Well, the potential conflict of interest is in the code of conduct, and there is a potential conflict of interest in what you're speaking about. But at the same time, like, that's the normal practice that was done, and that's the way things were done until now. Well, probably until 2012, I'd say, until the central bank examined the banks and they came up with different proposals as what should happen. But valuers would be very happy with this and would have had looked for this on lots of different occasions, because if you go to value something for somebody and they're not happy with the valuation, and you're in a small area or even you're in a big area, it's not a great situation to be in, because they will obviously want bigger values and the valuer doesn't do it. So, like, you have very little choice as to what you're going to do. You have to say to them, look, I can't do that, I'm sorry, you may ask somebody else or do something different or whatever you want, but I can only do a valuation for you to this value.
Would that be a likely outcome in such a situation where such pressure was coming down on a valuer?
It could be. It depends on how well they know the person and how well they knew them and what happened with them. You know, like, it could well be. But like most cases, valuers would have to value the property, and the end result isn't always what people wanted, but that's what you have to do.
During the boom years, then, we had a small number of large developers having a disproportionate share of land and property development. So, how would the valuation process mitigate against the risk of a developer, you know, using that position to have the values increased in a general way?
You mean asking the valuer to increase the values? Yeah,
but even by point of view of, say, where you're in an almost cartel-like position or monopoly-type position, you can use your land banks to influence potential valuations because you're able to put the pressure on the valuers given your size in the market.
Well, you're able to put pressure on the valuers if the valuer will take the pressure, and that's fair enough. But also the valuer has to have, like, a valuer is mostly, if I could put a scenario to you, like on a Monday morning, a valuer going to work in his valuating office, and he would see headlines maybe on the way in that somebody went to an auction on Friday and they bought a piece of land which is a record price. So that record price that particular piece of property made on the Friday previous is the new comparable that valuer has to use if he's doing valuations in that week. He can't go back and use comparables that he had the week before that, which was probably a lesser price. So as Cardinal's values moved up and valuations moved, the valuation price moved up as well. So, like, if builders went and they paid over the top for land or whatever they paid for it, the valuer had to use those comparables, because if you didn't use those comparables, you weren't doing what you were actually paid to do. You weren't doing a proper valuation of the property.
But can that then become a self-fulfilling mechanism to increase property values in general?
Sorry, I didn't...
Can it become a self-fulfilling mechanism whereby someone pays a particular price, that then sets a new value? The valuer then comes to value a piece of land close to it or similar to it the following week. There's now a new value placed.
That's correct. That is correct. And that's the same...
Self-inflating, if you like.
That's the same today. Like, if somebody wants to pay a different price for a property, the valuer must take it into consideration.
Okay. I mean, how do we explain then a situation whereby someone might put a value or a perceived value in terms of bidding for a property and have a valuation done subsequently that would come in at the same amount? I'll give you an example. If you look at Deputy O'Donnell's raised before with the Irish Glass bottle site, where there was a valuation, I think, in 2006 of 264 million. That same year, a bid was made for 411 million. And then the organisation Beckbay had to get financing from Anglo-Irish Bank, so they had the site actually valued after they'd made the bid, and the valuation came in at 412 million.
Okay.
It was only out by 1 million.
Okay.
Well, how do you explain that?
Well, I can't explain it because I haven't seen the valuation, but I've heard lots of talk about it. So, like, you know, the valuer, it wouldn't be any different, for the valuer has to do the same thing. They have to come up with the comparable evidence to prove the valuation. So if they didn't come up with the comparable evidence to prove the valuation, well, then obviously, again, we have a fallback position of the professional indemnity insurance.
Thank you. And just to clarify, then, when you're doing a valuation, there is no future element. You don't look forward as to where the property sector might be going or where values might be going. It's the valuation?
Not with open market value.
Okay.
IPAV have talked about, and actually we've met about different times, and we talked about a mortgage lending value, which could be used, which is a different value, but the value that banks look for is an open market value. So an open market value is what you have to do.
And when there is no market?
Well, if there's no market, then you will put in your report, when you do up your report, you'll do up your report at the bottom, you'll say that there's possibly not as good of evidence for comparable valuations as what I would like. But at the same time, like, you have to try and look for as much comparable evidence as you can get. That's what you have to do.
But if you think that the market is maybe going into decline, you can't factor that into the valuation you give on that point in time. Thank you.
You can factor it in, because obviously it could be used as an assumption, a special assumption it could be used as, and you can factor it in, yes.
Okay, thank you.